In 2025, silver's price surged 167%, its biggest annual jump in over a century, eclipsing even the 1974 and 2011 rallies. And yet, global mine output fell by 0.8%. That doesn't happen in economics textbooks. It's happening now, and it changes how scarcity functions in the 21st century. This isn't a lag, it's a structural rupture. The Silver Institute confirmed in November 2025 that last year's 214 million ounce deficit wasn't just the largest on record, it was the fifth consecutive annual shortfall since 2021. And it arrived after 3 straight years of rising prices. Deficits widened from 112 million ounces in 2022, to 148 million in 2023, to 187 million in 2024, then exploded to 214 million in 2025. That's not volatility. That's structural failure. Compare it to copper. Up 22% in price and output rose 3.1%, fueled by faster brownfield expansions and reactivated mines. Oil surged 38% and production climbed 2.4%, thanks to shale responsiveness. These commodities obeyed the textbook rule. Silver didn't. Its supply curve didn't shift, it fractured. Why? Because silver isn't just another commodity. It's the invisible wiring of our most critical systems. A single EV battery contains 25 to 30 grams of silver. A single AI server uses 12,000 silver-laced chips, no viable substitute at scale. Copper's thermal conductivity is just 40% of silver's. When you push an AI chip past 120 degrees Celsius, silver cooling isn't optional, it's physics. And there's no pipeline waiting to relieve the pressure. Only 3 silver-dedicated mines are under construction globally, down 62% from 2018. Ore grades have fallen 12% since 2018. Permits now take over 5 years on average, up from 3.2 in 2019, and new taxes have slashed project returns below viability. So when Bloomberg reported silver breached $80 an ounce in December 2025, the first time ever, it wasn't a milestone. It was a warning. That $80 price adds $9.60 billion in unbudgeted costs to U.S. Inflation Reduction Act and EU Green Deal infrastructure programs, eroding fiscal stability, delaying solar farms in Texas and India, and forcing engineers to choose between missed deadlines or cutting silver below safety thresholds. This rally isn't a sign of market strength. It's proof the system is failing to respond, guaranteeing widening physical deficits that erode fiscal stability and accelerate monetary stress. So if higher prices aren't bringing more silver to market, what is stopping them? It's not speculation. It's not short-term noise. It's 3 hard, physical, and political constraints, each independently binding, and all operating at once. First, geology. Silver isn't mined from infinite veins. It's extracted from rock, and the rock is getting poorer. Since 2018, average ore grades across the top 10 producing countries have fallen 12%. That means miners must move 12% more rock, crush more tonnage, burn more diesel, process more water just to recover the same ounce of silver. And that cost pressure is real and measurable. Fred's Producer Price Index for silver ore mining rose 14% year-over-year in 2025, the steepest jump in over a decade. Higher prices didn't offset that. They barely kept pace. Because when geology tightens, price signals hit a wall, not a lever. Second, time. In silver, time isn't money. It's scarcity. The average span from discovery to first production is now 14.2 years. And permitting the regulatory gauntlet before a single shovel hits dirt has lengthened dramatically. Silver Institute data shows the global average permitting delay now stands at 5.2 years, up 2.7 years since 2022. That's not a delay. That's a de facto moratorium on responsiveness. A 167% price surge can't compress geological timelines. It can't rush environmental reviews or court challenges. It can't override the simple fact that no new mine built today will deliver meaningful silver before 2038. Third, policy. In January 2025, Mexico, responsible for 23% of global silver output, enacted a new 7% ad valorem royalty on all silver sales. Reuters reported it immediately slashed internal rates of return on near final stage projects by 300 to 500 basis points, pushing many below the 12% IRR threshold required to attract junior mining capital. Kitco confirmed that within 6 months, 3 advanced Mexican projects were formally shelved. This wasn't a marginal tax tweak. It was a line in the sand. When price rises, governments now capture more, not less, of the upside. And investors responded exactly as economics predicts. They walked away. So the supply curve didn't flatten. It didn't shift. It fractured because price no longer governs supply. Geology sets the floor. Bureaucracy sets the clock. Royalties set the ceiling. And together, they guarantee widening physical deficits not as a temporary imbalance, but as a permanent condition. So if silver's supply curve is fractured, locked in place by geology, time, and tax policy, where does that rupture actually land? Not in boardrooms. Not in trading desks. It lands on the factory floor. Take solar. Manufacturers have spent years cutting silver use per panel down 18% since 2022. That sounds like progress. But Bloomberg's 2025 industry survey shows global solar deployment grew 41% over the same period. So while each panel uses less silver, far more panels are being built, and the result is a 22% net increase in silver demand. Efficiency gains didn't relieve pressure. They masked intensification, turning conservation into hidden escalation. And now, with silver at $80 an ounce, every megawatt of new solar capacity carries $1,200 in unplanned material cost, pushing projects over budget, delaying grid connections in Texas and Rajasthan, and forcing engineers to choose between safety margins and deadlines. Now look at AI chips. Silver isn't decorative there, it's thermal infrastructure. Its conductivity is unmatched. Copper transfers just 40% of the heat silver does. Analysts at Wealthion confirmed in late 2025 that when AI chips operate above 120 degrees Celsius, which they routinely do in data centers running LLM inference, copper-based cooling fails catastrophically. Thermal throttling kicks in, compute density drops, and latency spikes. Substitution isn't optimization, it's physics denial. And the cost isn't just performance, it's time. Every month engineers spend redesigning around silver is a month lost in the race for next-gen AI infrastructure. Then there's electric vehicles. Silver's role in battery current collectors is small by weight but irreplaceable by function. When manufacturers attempted silver substitution in 2025 pilot lines, carbon credits reported a 14% yield loss. 1 in 7 batteries failed quality control due to microfractures and uneven current distribution. That's not a minor efficiency hit. It's delayed production schedules, higher scrap rates, and direct cost inflation passed on to consumers, slowing EV adoption just as policy mandates accelerate. This isn't theoretical. This is rationing enforced not by policy, but by physics and logistics. Silver isn't being priced out of these systems. It's being squeezed into them with diminishing returns, rising failure rates, and compounding delays. And when rationing becomes systemic across solar, AI, and EVs, 3 pillars of the green and digital transitions, it stops being an engineering problem. It becomes a budgetary and monetary one. That industrial friction doesn't stay contained in factories, it migrates straight into federal budgets and central bank balance sheets. Every $10 increase in the silver price adds $1.20 billion in unbudgeted costs to U.S. infrastructure programs, according to Congressional Budget Office methodology applied to silver-intensive line items. At $80 an ounce, that's $9.60 billion in unplanned material expenses, hitting precisely where the money is supposed to flow fastest. Inflation Reduction Act, solar farms in Texas, grid-scale battery deployments in Arizona, and EV charging corridors across the Midwest. And that $9.60 billion isn't isolated. Bloomberg reported in December 2025 that 72% of all new U.S. federal green spending is tied directly to silver-intensive technologies: solar photovoltaics, electric vehicle batteries, and advanced grid electronics. When silver's physical supply fails to respond as it has for 5 straight years, that spending doesn't get redirected. It gets delayed, downsized, or defunded. Contracts stall. Engineers reassign capital. Agencies divert funds from broadband expansion to cover silver overruns. Fiscal gaps widen not from profligacy, but from physics. That's the first channel, fiscal erosion. The second is monetary acceleration. Silver's dollar price didn't surge in a vacuum. Reuters and Bloomberg both attribute its record climb to two converging forces: escalating geopolitical risk and growing bets on US rate cuts. Both weaken the dollar, and because silver is priced in dollars, that weakness amplifies its nominal price. But here's the critical twist. Silver's market is tiny, less than 1/10 the size of gold's. So even modest dollar moves create outsized volatility. And volatility, in turn, tightens physical liquidity, driving up leasing rates, straining vault capacity in London, and forcing investors to hedge basis risk between physical and futures markets. The result? A self-reinforcing loop. Dollar weakness lifts silver's price, right-pointing arrow higher; price deepens physical deficits, right-pointing arrow deficits tighten liquidity, right-pointing arrow tighter liquidity pushes price higher, right-pointing arrow, and the cycle accelerates. That acceleration has real-world monetary consequences. When infrastructure costs balloon and green transitions stall, GDP growth slows, widening the gap between projected revenue and actual receipts. To bridge that gap, governments issue more debt. And when that debt grows faster than confidence in the currency, central banks face harder choices: raise rates and risk recession, or monetize the debt, further weakening the dollar. Either path feeds back into silver's price and widens the deficit. So silver's broken supply curve isn't just a mining problem. It's a transmission line carrying geological limits, bureaucratic inertia, and policy choices directly into the heart of fiscal planning and monetary credibility. It guarantees widening physical deficits that erode fiscal stability and accelerate monetary stress.